Welcome to Mind Over Money, Biases in Action, where we explore how everyday mental shortcuts shape economic choices and market outcomes. In this lecture, we'll trace common biases, see how they distort decisions, and discover practical tools for managing them, all with the aim of turning predictable errors into smarter, more intentional financial behavior. Heuristics are mental shortcuts that save cognitive effort but produce predictable errors. And this slide maps out the main players: loss aversion, anchoring, and overconfidence. Think of heuristics as fast pathways that sometimes lead us astray, creating systematic deviations from rational choice and generating measurable effects across investments, pricing, and policy decisions. Loss aversion describes our tendency to weigh losses more heavily than equivalent gains, and it shows up in classic experiments, marketing, scarcity tactics, and how people handle depreciating assets. From why discounts feel powerful to why investors hold losing stocks too long, this bias distorts choices and creates opportunities for better design and intervention. Anchoring bias occurs when the first numerical cue becomes the reference point and skews subsequent judgments, whether it's a marked-up MSRP making discounts seem larger, an initial real estate list price shaping offers, or IPO pricing bands guiding investor bids. Recognizing anchors helps explain negotiation outcomes and suggests ways to reframe reference points for fairer decisions. Overconfidence and herd mentality together drive much market volatility, as individuals overestimate their abilities and then imitate one another during rising prices. That mismatch between perceived and actual skill leads to excessive trading, risk-taking, FOMO buying, mass adoption, and ultimately amplified boom-bust cycles that create systemic inefficiencies. Biased expectations feed persistent market anomalies like momentum, bubbles, and post-earnings drift, where collective overreactions, underreactions, and the disposition effect misprice assets over time. In short, predictable emotional and cognitive patterns cause prices to deviate from fundamentals, producing exploitable distortions that can persist even among professional traders. We can also exploit behavioral biases constructively. Defaults and status quo options, increase participation in beneficial programs, social norm labels nudge behavior by comparison, and simplified disclosures reduce cognitive load so people make more informed choices, all delivering measurable welfare gains when applied transparently and ethically. Counteracting impulse follows a simple three-step routine. First, slow down with checklists or cooling-off periods to force reflection, then actively seek dissenting data and premortems to challenge confirmation bias, and finally set predefined exit rules to reduce emotional portfolio churn and make decisions based on clear criteria rather than short-term feelings. Structuring environments for better choices makes the wise option the easy option by using automated segmentation to split paychecks for savings, curating choice architecture to limit paralysis, and reframing outcomes to emphasize opportunity rather than loss, all practical tweaks that steer behavior without removing freedom. Nudges must preserve autonomy and target welfare, not profit alone. So this slide contrasts transparent, welfare-oriented nudges with covert dark patterns that manipulate users for gain. The takeaway is clear. Regulators and firms should apply behavioral tools responsibly, prioritizing disclosure, choice preservation, and ethical impact over hidden profit maximization. Emerging research frontiers are combining AI personalization, real-time biometric feedback, and cross-cultural studies to design smarter interventions, and integrating transaction logs with psychological profiles promises more targeted policy and education. These innovations open the door to tailored nudges that respect context and individual differences while improving economic outcomes. Awareness turns predictable biases into a strategic advantage by pairing insight with structured tools so we can mitigate risks and transform errors into informed strategy. As a practical challenge, audit one daily economic decision tonight to spot hidden biases and practice conscious decision-making that will, over time, improve both personal and institutional outcomes.